People ask me all the time if I think there will be another banking crisis. They point to 2008, they point to the savings and loan crisis of the early 1990s, they point to the regional banking stress we saw in 2023 with Silicon Valley Bank and Credit Suisse, and they want to know when is the next one coming. Here's what I tell them, and it's not what they want to hear. The next banking crisis isn't coming, it's already here. It's happening in slow motion right in front of our eyes, and most people can't see it because they're looking for the wrong signals. They're expecting another Lehman Brothers moment, another sudden collapse that happens over a weekend, but this time is different. This time the crisis is structural, systemic, and it's going to unfold over years, not days. I've been running JPMorgan Chase for over 20 years now. I've lived through multiple banking crises. I've seen what kills banks, and I've learned to recognize the warning signs before they become obvious to everyone else. And right now I'm seeing 4 critical warning signals that tell me the banking system, as we know it, is heading for a fundamental breakdown. These aren't temporary problems that will be solved by changing a few regulations or adjusting interest rates. These are existential threats to the traditional banking model, threats that will separate the survivors from the casualties over the next decade. And if you don't understand these threats, if you're not positioned properly for what's coming, you could lose everything you've worked for. The first warning signal is something that should terrify anyone who understands how banking works. Leverage ratios across the financial system have reached levels that are fundamentally unsustainable. And I'm not just talking about bank leverage, I'm talking about leverage everywhere: corporate leverage, household leverage, government leverage, and yes, banking leverage. Let me start with the banks, because that's what I know best. Right now, the average Tier 1 leverage ratio for major US banks is around 8% to 9%. That means for every dollar of capital they have, they're lending out about $11 to $12. That might sound conservative compared to the investment banks of 2007 that were leveraged 30 to 1, but it's not conservative at all when you consider the quality of the assets and the stability of the funding. What most people don't understand is that leverage ratios don't tell the whole story. You have to look at what banks are actually lending against and how they're funding those loans. Today's banks are holding massive amounts of commercial real estate loans, and commercial real estate is facing its worst crisis since the 1980s. Office buildings sitting empty because of remote work. Retail properties devastated by e-commerce. Hotels and restaurants still struggling with post-pandemic dynamics. At JPMorgan, we've been dramatically reducing our commercial real estate exposure for the past 3 years because I can see what's coming, but smaller and mid-sized banks haven't had that luxury. They're sitting on hundreds of billions of dollars in commercial real estate loans that are going to default over the next few years, and when those defaults hit, their capital ratios are going to collapse. But it's not just commercial real estate. Banks are also sitting on massive unrealized losses in their bond portfolios. When the Federal Reserve raised rates from 0 to over 5% in just 18 months, the value of long-term bonds held by banks collapsed. Silicon Valley Bank failed because they had to realize those losses when depositors demanded their money back. But guess what? Every other bank has the same problem. They just haven't been forced to realize the losses yet. Here's the math that keeps me awake at night. If interest rates stay elevated or, God forbid, go higher, banks across the system will be forced to recognize hundreds of billions of dollars in bond losses combined with the commercial real estate defaults that are coming, and you're looking at a capital crisis that makes 2008 look manageable. But the leverage problem goes beyond banks. Corporate America is sitting on record amounts of debt, much of it at floating rates that reset higher as interest rates rise. Household debt is at record levels, with consumers stretched thin by inflation and higher borrowing costs. And government debt, both federal and state, is reaching levels that many economists consider unsustainable. All of this leverage worked fine when interest rates were 0 and asset prices were rising. But now that rates are elevated and asset prices are under pressure, the entire leverage edifice is starting to crack. And when it breaks, it's going to take the banking system down with it. The second warning signal is interest rate risk, and this one is more dangerous than most people realize because it's hidden in plain sight. Banks make money by borrowing short-term and lending long-term. They pay depositors maybe 1% or 2% on savings accounts and charge borrowers 6% or 7% on mortgages. The difference is their profit margin. This model works beautifully when interest rates are stable or declining, but it becomes a death trap when rates rise rapidly, which is exactly what we've experienced over the past 2 years. Banks that made long-term loans at 3% when rates were low are now having to compete for deposits by paying 4% or 5%. They're losing money on every loan they made during the low-rate environment. Silicon Valley Bank was the canary in the coal mine. They had loaded up on long-term government bonds when rates were near zero, thinking they were being conservative. When rates spiked, those safe government bonds lost 20% to 30% of their value. When depositors got nervous and started withdrawing money, SVB was forced to sell those bonds at massive losses, which triggered a classic bank run. But here's what's terrifying. Silicon Valley Bank wasn't an outlier. They were typical. Hundreds of banks across the country have the same interest rate mismatch problem. They have long-term assets yielding 2% to 3% and short-term liabilities costing 4% to 5%. The math doesn't work. At JPMorgan, we've spent decades building sophisticated interest rate risk management systems. We use derivatives to hedge our exposure. We stress test our portfolios against multiple rate scenarios. We maintain flexibility in our funding structure. But most banks don't have these capabilities. They're sitting ducks. And here's what makes this even more dangerous. The Federal Reserve isn't done raising rates. Inflation is proving more persistent than they expected. The labor market remains tight, and fiscal policy is still stimulative. The Fed might have to take rates even higher to bring inflation under control. Every additional rate increase makes the interest rate risk problem worse for banks. The third warning signal is regulatory pressure that's reaching a breaking point. Ever since 2008, regulators have been loading more and more requirements onto banks: higher capital requirements, liquidity requirements, stress testing, resolution planning, consumer protection rules, anti-money laundering compliance, cybersecurity standards, climate risk assessments. The list never ends. Don't get me wrong, some regulation is necessary and appropriate. The excesses that led to 2008 needed to be addressed, but what we have now has gone far beyond reasonable oversight. We have regulatory overkill that's making it increasingly difficult for banks to function as banks. Here's a concrete example. The Volcker Rule, which was supposed to prevent banks from proprietary trading, has become so complex and burdensome that it's preventing banks from providing basic market-making services to their clients. The rule is over 900 pages long and requires banks to track and report thousands of different metrics. We've had to hire armies of compliance officers just to navigate it. Or take the comprehensive capital analysis and review the annual stress testing that large banks have to undergo. The scenarios keep getting more and more severe, requiring banks to hold more and more capital against increasingly unlikely outcomes. We're now required to hold enough capital to survive the economic depression worse than the 1930s. That capital could otherwise be used to make loans to businesses and consumers. But the real problem isn't any single regulation. It's the cumulative effect of all of them. Compliance costs for large banks now run into the billions of dollars annually. We employ more compliance officers than many banks employed total employees 20 years ago, and these costs are only going in one direction, up. Smaller banks are being hit even harder. They don't have the scale to absorb massive compliance costs, so regulation is literally driving them out of business. We've lost over 2,000 banks in the United States since 2008, mostly due to regulatory burden. That's a 25% decline in the number of banks, and it's accelerating. The result is a banking system that's becoming increasingly concentrated in a handful of large institutions. But concentration creates systemic risk. When there are fewer players, each player becomes more systemically important. When one of us has problems, it affects the entire system. And here's the kicker. All of this regulation isn't actually making the system safer. It's making it more fragile, more concentrated, and more vulnerable to systemic shocks. We're regulating banks to death in the name of safety, but we're actually creating the conditions for the next crisis. The fourth and most dangerous warning signal is technological disruption that's undermining the fundamental business model of banking. For centuries, banks have had a monopoly on moving money, storing money, and lending money. That monopoly is ending, and most traditional banks aren't prepared for what comes next. Fintech companies are attacking every aspect of banking. Payment companies like PayPal, Venmo, and Zelle are making bank branches obsolete. Lending platforms like Lending Club and Prosper are using algorithms to make credit decisions faster and cheaper than traditional banks. Robo-advisors are providing investment services at a fraction of the cost of traditional wealth management. Cryptocurrency and blockchain technology represent an even more fundamental threat. Bitcoin and other cryptocurrencies allow people to store and transfer value without any involvement from banks. Decentralized finance platforms allow people to lend and borrow money directly from each other, cutting out traditional financial intermediaries entirely. Central bank digital currencies, which are being developed by governments around the world, could eliminate the need for commercial banks altogether. If the Federal Reserve issues a digital dollar directly to consumers, why would anyone need a checking account at a bank? The Fed could provide all the basic banking services that people need and do it more efficiently than private banks. But the biggest threat comes from the technology companies themselves. Apple, Google, Amazon, Facebook. These companies have billions of customers, sophisticated technology platforms, and virtually unlimited capital. They're already moving into financial services, offering payment systems, credit cards, and investment services, and they're just getting started. Imagine a world where you do all your banking through your iPhone using Apple's payment system, Apple's credit products, and Apple's investment platform. Apple already knows more about your spending habits than your bank does. They have better technology, better user interfaces, and better customer data. Why would you continue to use a traditional bank? At JPMorgan, we're spending $15 billion annually on technology to stay competitive. We're building digital platforms, improving our mobile apps, developing blockchain capabilities, but we're fighting against companies that are digital natives that don't have legacy systems to maintain, that can move faster and innovate more quickly than traditional banks. The smaller banks don't stand a chance. They don't have the resources to invest in technology. They can't compete on convenience or user experience, and they're losing customers every day to fintech alternatives. Many of them will simply become obsolete over the next decade. But here's what really worries me. Most traditional banks are approaching this technological disruption as if it's just another business challenge to manage. They're not recognizing that it's an existential threat to their entire business model. They're trying to defend their existing franchises instead of reimagining what banking could become. The banks that survive will be the ones that embrace technology, that partner with fintech companies instead of competing with them, that focus on the things that technology can't easily replicate, but most banks aren't making that transition fast enough. Now, let me bring all four of these warning signals together and explain why they create a perfect storm that's going to destroy the traditional banking system as we know it. Each of these problems would be manageable individually. Banks have survived high leverage before, they've navigated interest rate cycles before, they've adapted to new regulations before, and they've competed with new technologies before. But dealing with all four simultaneously, that's a different challenge entirely. High leverage makes banks vulnerable to any shock. Rising interest rates are creating those shocks by destroying asset values and increasing funding costs. Regulatory pressure is preventing banks from taking the actions they need to address these problems. And technological disruption is eating away at their revenue base, making it harder to earn their way out of trouble. It's a vicious cycle. As banks become weaker, regulators impose more restrictions. As regulations become more burdensome, banks become less competitive with fintech alternatives. As fintech companies gain market share, traditional banks lose revenue and become even weaker. As banks become weaker, they become more vulnerable to interest rate risk and credit risk. The end result is a banking system that's simultaneously overregulated and undercapitalized, technologically obsolete and systemically important, profitable in the short term, but unsustainable in the long term. So what does the collapse look like? It's not going to be a sudden dramatic failure like Lehman Brothers. It's going to be a slow motion train wreck that unfolds over years. Banks will gradually become less profitable, less relevant, and less stable. Some will fail outright. Others will be forced to merge with stronger institutions. Many will simply fade away as customers migrate to digital alternatives. The survivors will be a handful of large, technologically sophisticated institutions that can compete with the tech giants, plus some specialized niche players that serve specific market segments. The broad middle tier of traditional commercial banks, the regional banks, the community banks, the old-fashioned relationship lenders, they're going to disappear. And here's what most people don't realize. This isn't necessarily a bad thing for consumers. The new financial ecosystem that emerges from the wreckage of traditional banking could be more efficient, more convenient, and more competitive than what we have now. Digital payments are faster and cheaper than traditional banking. Algorithmic lending can provide credit decisions in minutes instead of weeks. Robo-advisors can provide investment management at a fraction of traditional costs. But the transition is going to be brutal for anyone who works in traditional banking, anyone who invests in bank stocks, and anyone who depends on traditional banks for credit or other services. Millions of banking jobs will disappear. Trillions of dollars in bank stock value will be destroyed. Small businesses and individual borrowers who depend on relationship-based lending will struggle to find alternatives. If you work in banking, you need to start preparing for this transition now. Develop skills that are valuable in the new financial ecosystem, technology skills, data analysis skills, customer experience skills, or consider moving to one of the institutions that's likely to survive the tech giants that are moving into financial services or the large banks that are successfully navigating the digital transition. If you invest in bank stocks, you need to be very selective. Most traditional banks are value traps that will continue to decline over time. Focus on the institutions that are investing heavily in technology, that have strong capital positions, and that are adapting their business models for the digital age. If you depend on traditional banking services, start exploring digital alternatives now. Get comfortable with mobile payments, online lending platforms, robo-advisors, and other fintech solutions. Don't wait until your bank fails or becomes irrelevant to start making the transition. The banking crisis is coming, but it's not going to look like the crises of the past. It's going to be slower, more complex, and more transformative than anything we've seen before. The question isn't whether it will happen. The question is whether you'll be prepared when it does. I've positioned JPMorgan Chase to survive and thrive through this transition, but I recognize that we're in the minority. Most banks are sleepwalking into obsolescence, and their customers, employees, and investors are going to pay the price. The warning signals are clear, the trends are accelerating, and the outcome is inevitable. The only question is how long it takes to play out and how much collateral damage occurs along the way. But mark my words, the banking system of 2035 is going to look nothing like the banking system of today, and most of today's banks won't be around to see it.